Private real estate performance, bank lending standards, and commercial real estate debt spreads. That's what I'm watching this month. Welcome to the Real Estate Reel from Cohen Steers, where we provide 3 insights on real estate investing in 3 minutes each month. First, private real estate, as measured by the NCREIF Odyssey Index, declined negative 2.7% in the second quarter. That's the 3rd consecutive quarter it has dropped, and private real estate is now down 10.4% from its peak in the 3rd quarter of 2022. By comparison, as you can see in this chart, listed REITs have increased for 3 consecutive quarters and are now up 13% as of the end of 2Q23 from their trough that was also in the 3rd quarter of last year. That private peaked and listed troughed at the same time is not a coincidence. Listed REITs are a leading indicator for private valuations, both in a downturn and a recovery. The sell-off in private is one indication of several we track that there may be an attractive entry point for listed REITs. The 3 recently quarterly declines in private real estate rank as the 5th, 8th, and 9th greatest declines since 1978. When you look at the 10 prior greatest declines in the Odyssey Index, listed REITs have actually never been down over the next 12 months following those drops. The second set of data I'm watching this month, it's bank lending standards. The Senior Loan Officer Opinion Survey on Bank Lending Practices, which is a quarterly survey of over 100 banks that Fed conducts, showed that a major net share of banks reported having tightened standards on all categories of commercial real estate loans. What I don't think is getting enough attention is that lending standards stabilized during the second quarter. This was driven by large banks starting to loosen while smaller banks continued to tighten. Lending standards have historically been a leading indicator for real estate, as we can see in this chart. Listed REITs have declined as they stood at negative 23% below their prior peaks at the end of 2Q23 and were as low as negative 32% at their trough in 3Q22. The level of tightness indicated by the survey suggests that private valuations could decline 20 to 25% in total. Typically, it takes 18 to 24 months for private to catch up to listed, though we expect it to be quicker this time. Finally, commercial real estate debt spreads are actually tightening. As of the end of the July, REIT spreads have tightened 42 basis points from the wide levels observed in March, when bank failure sparked wider market concerns about the economy and potential contagion. Commercial mortgage-backed security AAA spreads have tightened 55 basis points since then. The market is coming to terms with the fact that the headwinds facing commercial real estate debt will be a slow burn over a longer period, but that's better than the collapse the market feared in March. As noted in this chart, tightening debt spreads have been a tailwind for listed returns over the past couple of months. Bottom line, we continue to believe there are favorable entry points for listed real estate investors. And while private real estate valuations may have further to fall, we are beginning to see selective opportunities emerge. So what we'll be watching next month? Use the link on the screen to subscribe to our next insight.